What lowers your business valuation? In today's video, we will cover what really lowers your business valuation. You believe your company is worth 10 million. An investor comes back and says it's worth 6 million. What happened? In most cases, investors are not trying to undervalue your business. They are adjusting for risk. In this video, we'll break down the most common factors that reduce business valuation and why investors discount value during negotiations. Understanding this changes how you prepare for fundraising. First principle: valuation falls when risk rises. Before we go into specifics, understand the core logic. Valuation is based on expected future returns, adjusted for risk. If risk increases, the discount rate increases. If the discount rate increases, valuation falls. It's that simple. Now let's look at what increases perceived risk. 1. Slow or uncertain revenue growth. Growth drives valuation. When revenue growth slows, valuation multiples compress. Example: a software company growing at 70% annually may trade at 8 times revenue. If growth slows to 20%, that multiple might drop to 3 times or 4 times. Even if revenue hasn't fallen, just growth slowing can reduce valuation significantly. Investors discount when growth is inconsistent. Revenue spikes are one-off. Forecasts are unrealistic. Unstable growth increases uncertainty. 2. Over-optimistic financial projections. Founders often present aggressive projections. Investors then haircut them. Example: founder projects 5 times revenue growth in 12 months. Investor may assume 2 times instead. When projections are unrealistic, credibility drops. Risk perception rises. Valuation gets discounted. Sophisticated investors stress test assumptions. If projections rely on perfect execution, valuation falls. 3. Weak profitability or poor unit economics. Revenue without profitability is not automatically valuable. Investors look at gross margins, customer acquisition cost, lifetime value, burn rate. If it costs $200 to acquire a customer who generates $150 in gross profit, the model is not sustainable. Even high-growth startups face valuation pressure if unit economics are weak. Investors discount when profitability visibility is unclear. 4. High customer concentration. If one customer represents 40-60% of revenue, valuation drops. Why? Because losing that customer would materially damage the business. Diversification reduces risk. Concentration increases it. Investors often apply lower multiples when revenue dependency is high. 5. Founder or key person dependency. If the business relies heavily on one individual, risk increases. Examples: founder controls all sales relationships. Founder is sole product developer. Founder holds critical operational knowledge. If that person leaves, performance may collapse. Investors discount businesses that lack management depth. Building a team increases valuation by reducing this risk. 6. Weak competitive positioning. If your product can easily be replicated, valuation suffers. Investors look for defensibility, intellectual property, network effects, brand strength, exclusive partnerships, regulatory barriers. Without defensibility, pricing power weakens. Lower pricing power, lower future margins, lower valuation. 7. Legal or structural problems. Valuation is reduced when there are unresolved legal or structural issues. Common examples: messy cap table, unclear shareholder agreements, pending litigation. Regulatory noncompliance, undocumented IP ownership. These issues introduce transaction risk. Investors may reduce valuation, add protective clauses, delay investment. Clean structure increases confidence. 8. Market conditions. Sometimes valuation drops have nothing to do with your performance. Macroeconomic factors matter. Examples: rising interest rates, sector downturn, reduced venture funding liquidity, public market correction. When public market multiples compress, private valuations follow. Even strong companies may face valuation pressure during downturns. This is market risk, not company weakness. 9. High cash burn, without clear path to profitability. If your business consumes capital rapidly without a clear plan to reach sustainability, investors increase risk adjustments. High burn is not inherently bad, but it must support scalable growth. If burn appears inefficient, valuation declines. Investors want to see capital efficiency. 10. Lack of financial transparency. Disorganized financial records reduce valuation. If investors struggle to understand revenue breakdown, cost structure, debt obligations, cash runway, they apply a risk discount. Clarity builds trust. Uncertainty reduces price. Practical example. Consider two companies with identical revenue of $3 million. Company A, growing 60% annually, strong gross margins, diversified customers, clear reporting, experienced team. Company B, growing 15%, high burn rate, one major client, messy financial records, heavy founder dependency. Even with the same revenue, Company B may receive a significantly lower valuation multiple. Valuation reflects quality, sustainability, and risk, not just revenue size. Why investors push down valuation? From the founder's perspective, it may feel like negotiation pressure. But investors are pricing risk. They ask, what could go wrong? How predictable are cash flows? How scalable is the model? What protects this business long term? When uncertainty increases, valuation decreases. Final thoughts. Understanding what lowers valuation is just as important as understanding what increases it. If you want a stronger valuation, reduce operational risk, strengthen financial clarity, improve defensibility, diversify revenue, present realistic projections. Valuation is not emotional. It is a structured reflection of risk-adjusted future potential. If you would like to understand how these factors influence your own valuation, you can try the free business valuation calculator at www.valuation4u.com. And if this video was helpful, subscribe for more clear guidance on valuation, equity, and fundraising strategy. Ain't I the tea?